A longer-term outlook for PGM as well. Without further ado, let's welcome the Head of Research, World Platinum Investment Council, Edward Sterck, to close the plenary session, day one for Shanghai Platinum Week 2026. Let's welcome Edward.
Well, thank you very much, Yvonne. So I'm just going to make some closing remarks, basically wrapping up what I think are some of the most interesting points that came out of what has overall been a really fascinating set of conversations and presentations today. Before doing that, however, I am just going to give you the WPIC, the World Platinum Investment Council view on investment flows through the course of this year. In terms of supply and demand dynamics, the investment flows that we've seen so far are having a really significant impact on where the balance of the market might end up as the year unfolds. So this is quite critical. It does, there is quite a lot of overlap with the previous set of panelists and presentations, so this shouldn't take too long. So firstly, I'm just going to start with a bit of an atomization of the price rally last year. Now, I think the key point to make really is that prices began to move higher from May, but in reality, this price rally was quite a long time in the making. We were 3.5 years into substantial market deficits based upon our supply-demand estimates, and those had resulted in a significant depletion of above-ground stocks, ultimately to unsustainably low levels. So in effect, those above-ground stocks have been balancing the market, and we'd reached a level where they were no longer available at a price that the holders of those stocks were willing to make them available to act as a balancing factor. Added to that, of course, if you kind of rewind to a little bit earlier, just before the start of 2025, you had the election in the US, you had Donald Trump come in, you had the emergence of very tariff-related rhetoric coming out of the incoming administration. That began to make the market, particularly in the US, of course, somewhat nervous. So we began to see things like lease rates move higher. We began to see a lot of metal move into the US. The visible portion of that was exchange stocks. And that tension just built up through the course of 2025 until we reached May of that year. And then the catalyst, as mentioned in the previous panel session, seemed to be a combination of two things. So firstly, as mentioned in the last session, we had the sort of news emerge that we were seeing wholesaler restocking or stocking of platinum jewelry in China. That sparked hopes of a Chinese jewelry resurgence. Obviously, as we know, that didn't quite work out as had been hoped. But you also saw quite a significant change in the way people were choosing to own platinum. So if you look at things like leasing volumes basically kind of ignored higher lease rates until May of last year and then dropped off pretty sharply. So it seemed like we reached the kind of pain threshold for people who had been leasing metal, and they transitioned from leasing more into ownership, and that catalyzed the beginning of the rally. And I'd categorize this rally through this period here up until sort of mid-Q4 as being really driven by those underlying fundamentals. You know, continued tension in the market, a continued shortage of metal. But as we moved into Q4, you began to see things become a little bit different. You began to see the attacks on the independence of the Fed that we just mentioned. This came after, obviously, the launch of the GFEX as well. But very clearly, through December and into January, platinum was very much trading in alignment with the whole precious metal complex, in alignment with gold, as a sort of risk-on asset in that regard, and very strong correlations there. The market reached fundamentally frothy levels in January and then began to reset, initially stabilizing at fairly sensible levels. But then, of course, you had the advent of the conflict in the Middle East, and that really transformed things in terms of inflation expectations on the back of higher oil and gas prices, and that translated into a market view would have higher US Federal Reserve rates. And of course, that's negative for US dollar commodity prices. So this is where we stand today. You know, what do we expect to happen through the course of the rest of this year? Well, before getting on to that, just a quick overview of bar and coin demand. So very clearly, the key trend here has been for increased ownership of bar and coin demand. Just going to exclude 2020 there, which was obviously an outlier year due to COVID, where we saw strong demand for bar and coin, particularly in the US. But one of the things to point out, of course, is that we've got quite a big geographic shift in ownership. China's become the biggest market globally for bar and coin demand, hitting as of last year, around 13 tonnes of demand, having risen from virtually nothing in 2018. And the projection for this year is for that to go through 14 tonnes of demand. Now, the area where demand has been lost has been in the US, so that's most of the grey bar being the United States, and that's largely due to things like the shortage of product availability on the back of higher lease rates, that's making, and difficulties in terms of things like tariffs that have created some confusion in the ability to bring product into the US. Just looking at the last column over here, that's as of the end of Q1, the annualized bar and coin demand. As you can see, it falls short of the projections that we still have for the whole of 2026. And that's largely due to the fact that we've seen sort of the momentum come out of the market, and that's translated into lower buying. Now, if we projected this beyond Q1, we haven't updated our numbers yet, but you'd see a further small erosion to that outlook. But what's been going on in the rest of the market? Well, this has been touched upon in the last session, but we have had, as a result of higher rate expectations, quite a lot of metal come out of ETFs, as you can see in the top left-hand chart. So around 16 tonnes of metal, or 500,000 ounces. And then also on the easing of the trade issues or trade concerns in the US, where we had seen this big build-up of CME vaulted inventories, we have seen around 8 tonnes of metal, or around 250,000 ounces come out of CME exchange stocks and move back into the market. So in total, if you look at the bottom chart, you can see that, in effect, we've had about 24 tonnes of platinum coming out of ETF holdings and exchange stocks on a year-to-date basis. That includes a bit of a balancing factor for the GFEX exchange stock builds that we don't have in our underlying numbers yet. And so net, in total, about 20 tonnes of platinum that's flowed back into the market. That's quite a lot. That's the equivalent of around 8% of global demand. Put it in mining terms, it's like having a 12% increase in mine supply. And so that, on our numbers, would be sufficient to push the market into a surplus for this year. So this is an area to keep an eye on quite closely. So what's the outlook? Well, I mean, to kind of explain the outlook, clearly, we've got to think about what's going to happen with inflation fears. So in effect, we seem to be missing a line on this chart. There should be another one just above there. Since the beginning of the conflict in the Middle East, we've seen a sea change in terms of US Fed Reserve rate expectations. They've moved from effectively higher by 90 basis points. That's the equivalent to going from 2 cuts pre the conflict to, in effect, 2 rate raises. But is the market overestimating this? And I would argue the market probably is. Firstly, as you can see in the right-hand chart, we've got an easing of oil and gas prices. To be fair, I think they're being slightly flattered by things like releases from strategic petroleum reserves, which need to be rebuilt, but that can happen over a more extended period of time. It's also worth considering what's been going on with some of the, so lower oil and gas prices obviously eases some of the inflation risks, and that could help bring down rate expectations. I'd also argue that some of the US economic data has been slightly flattered by certain factors, and I'd include the FIFA World Cup there. So on FIFA's estimates, potentially a $17 billion boost to GDP in the US and 185 temporary jobs that have been made. You're also seeing, and I was there in the US a few weeks ago, the surge pricing is really quite out of control, and people are paying up because they want this once-in-a-lifetime experience. So effectively, we're seeing a big splurge of public spending that, again, is kind of flattering the consumer spending numbers. And of course, after a splurge comes the hangover. So I think, if we roll forwards to kind of August, September, there's the possibility that we will see some of these economic indicators in the US soften, and again, that could be something that helps ease inflation fears. So just to wrap up our view on the coming drivers of investment demand, I think you've obviously got the new Fed chair come in, Warsh. I think he's really trying to use rhetoric to set the tone rather than necessarily intending to make real rate increases. And the reason I say this is twofold. Firstly, can the US afford it? If you look at this bottom left-hand chart, that's US debt to GDP. It's at its highest level ever, higher even than at the end of the Second World War. And if you think about this in terms of the cost of interest payments alone for short-term Treasury borrowings, it's about $600 million in interest payments alone for every basis point move in interest rates. So potentially quite significant extra payments that the US can't necessarily afford to make at the moment. You've also got a political environment that is little bit difficult for the Fed in terms of making rate changes. You've got the midterm elections in November. Typically, the Fed doesn't make important monetary decisions ahead of that, so maybe they've got only one sort of more rate-setting meeting later this month in order to make a change, and I doubt that would be more than 25 basis points, even if they do make one. So finally, just I think from our point of view at WPIC, we see falling inflation risks and monetary policy reality likely to lead a bit of a reset in terms of rate expectations. Clearly, lower rates are beneficial for the appeal of non-yielding assets, and that could bring investors back into the market later this year, rewind some of those ETF outflows. And of course, as mentioned in the last session, we haven't seen the end of Section 232 for critical minerals. We also have the Section 301 investigations into trade frictions between the US and 99% of its trade partners by value. All of those are due to come to a head in the course of the next few weeks or so, and could help bring that metal back into the US and potentially rebuild some of those exchange stocks. So overall, we think that the environment is actually potentially pretty constructive for investment as the year unfolds. So that's our view in terms of the investment flows for later this year. But just to wrap up briefly on, I think, the key takeaways from today's sessions. We've learned a number of interesting things, some of which you might well have been aware of, but some of which you might not have been aware of, certainly speaking for myself. So I think one of the first things we learned really was that South Africa and China have signed an economic partnership agreement earlier this year, and that just goes to obviously underscore the importance of the relationship between those two countries. We also heard that the commitment to SPW from WPIC is going to continue to change and evolve SPW to best suit the needs of the industry. We also heard from the LPPM with 113 current members, and that's continuing to grow. And interestingly, the data points on London PGM liquidity, so just London alone, before you bring in any of the derivative markets, being almost $6 billion globally. In terms of economics, I think the economic outlook that was presented by Bloomberg was actually not totally dissimilar to the analysis that we've just had in the last session and that I outlined, perhaps even a little bit more positive. So US economic growth being maintained on the back of AI infrastructure and defense spending. You do have the strong jobs market, potentially past peak inflation, but expecting no change to FOMC monetary policy. A comment on China there in a similar terms. The China economy is facing a sort of two-speed type outlook where you've got strong and robust exports and industrial output remaining pretty robust as well. But on the other hand, weakness in consumer spending that may prove to be a bit of a drag, with consumer spending remaining below COVID-19 levels, pre-COVID-19 levels. In terms of the PGM market, I think one of the really interesting things here was China 7, or the changes to exhaust emission legislation. Clearly, we're looking at a very different type of a regulatory environment with the dual track approach, blending the sort of US fleet-wide or bin type legislation, and then Europe being focused on the individual vehicle level. Clearly, in terms of PGM loadings, this could be really important, but I thought one of the interesting takeaways today in terms of China 7 was, although in theory this could lead to, or should lead to higher PGM loadings, you've got to offset that against the potential for technological innovation and the need to try and drive thrifting, of course. So it'll be interesting to see how that evolves over the course of the next couple of years. PGM catalysts was an area which I thought was particularly of note. We all know that platinum has got a significant number of end uses. Quite how many always never ceases to surprise, really. But effectively, everything from chewing gum resins to numerous products requiring hydrogenization and obviously precursor materials for synthetic fiber production. And then we heard about the potential for a number of different PGM catalysts within the downstream coal to gas industry. AI technology, I think this is an area that is really emergent in terms of the potential for an impact on the demand outlook. I think we're probably all underestimating the level of demand for PGMs so far, and potentially the level of growth. There's a personal aside here, just looking at China's 15th five-year plan. They're planning on spending, in dollar terms, $300 billion over this five-year plan on expanding AI, and in the US it's about $500 billion. So just to give you some idea of the potential scalability there. In AI, the PGM usage in semiconductors comes from the fact that their resistivity increases less than other metals as the semiconductor circuits are shrunk. So that's really the kind of unique factor that they have. And then, of course, the thermal stability, for example, in iridium crucibles and for ruthenium in a number of applications as well. Just in terms of the platinum demand for semiconductors, one takeaway that's directly from the presentation was AI-related products to reach 64.44 tons by 2030, accounting for 9.4% of total demand. That's a pretty significant, almost 23% compound annual growth rate between now and then. Medical applications, interesting to see that platinum and titanium diamond alloy rings have a unique role in operations due to their radio opacity, biocompatibility, and material properties. And then, just as we kind of came through into this afternoon session, I think what's very clear is the success of the GFEX in terms of going through the first delivery process, but also growing liquidity and the ability to manage price risk in China. And very importantly, the strong support from outside of China. You know, clearly the advent of the GFEX is seen extremely positively by other exchanges around the world, with the view being that it helps improve liquidity for everyone. In terms of other exchanges, we heard about the importance of China and Asia to the CME, in particular with regards to platinum and palladium metal volumes. And then finally, wrapping up with green hydrogen and the importance of green hydrogen within China's 15th five-year plan. Clearly it is an important target and an important tool in China's aim to become CO2 neutral by 2060. And success in green hydrogen is very clearly going to be engendered by increasing scalability and driving down the levelized cost of hydrogen. I thought it was interesting that 90% of fuel cell usage is likely to be in commercial vehicles. So clearly the heavy-duty transportation is an area that I guess we've kind of all been aware of as where the most benefits accrue. And then just on the economic session, you've only just heard it, but clearly the overall takeaway, I think, from everyone was actually pretty constructive on PGMs and the PGM outlook, and for very good, sound economic reasons in terms of the potential for the Federal Reserve outlook in terms of rates to begin to ease, and for that to potentially help in terms of the demand for non-yielding assets like precious metals. And of course, you've got the debasement trade and the potential for that to return in the future, which is absolutely key to the US dollar strength in terms of its outlook. So that's it from me. I'm going to say thank you very much and for your attention today. We look forward to seeing you back here at 9 a.m. tomorrow. Thank you.